Hello everyone, let us continue with our discussion. So we are now going to enter into the next segment. See, when we have started the discussion of this particular topic, we have discussed a lot about the framework, strategic asset allocation. We have also discussed about the right approach, asset based approach, liability based approach, goal based approach. Then we enter into saying that okay, don't just look at the approach, try to put your portfolio through a factor perspective, okay, risk factor, because there is a possibility that the correlation with respect to the factor is high and hence you can suffer the risk. Clear? And then we have closed it with the strategic asset allocation. Clear? Now we are going to enter into the next segment of this topic, where we are going to discuss about some different approaches, okay, strategic implementation choices, how we can rebalance our portfolio considering the market momentum, considering the liquidity, derivatives, and everything. Are you clear with this? So now let us begin. So the first thing which you can see over here is the term global market portfolio. Okay. Now let us start. First of all, what is this global market portfolio? So basically it is a portfolio. Again, portfolio means what? Definitely it includes something. What it includes? It includes your all risky assets in the world. It includes all risky asset in the world in proportion to their market value. In proportion to their market value. So now what this global portfolio actually includes, it includes your global equity, all the equities around the world. I'm not talking about the domestic, it's global. Okay. Global fixed income, global real estates, global commodities, global private equity, and all other investable assets. Okay. Imagine that you want to own a small part of the entire world economy. Okay. So instead of just choosing Indian stocks, US bonds, or only real estate, okay, you buy everything, but more of a very big market you have tapped in a very small market. Clear? Means this is the whole world. Okay. And trust me, there is no such index available where you can invest and you can say that I have invested in the global portfolio. It's not available. Okay. Though you will find out the portfolio of the US, you'll find out the portfolio of Japan, but the global portfolio is nowhere available. So sir, can I practically, in reality, can I invest in the global portfolio? The answer is no. So it's like that you have to purchase all the stocks, all the US bonds, all the real estates, all the commodity, but in their proportionate. If some markets are big, then you have to buy more of it, and if some markets are small, then you have to buy lesser of it, because of the fact that it is weighted by their market value. Are you clear? Now the next point is why this financial theory always starts with a global market portfolio. Write down the first portfolio. The first portfolio an investor should look at, the first portfolio an investor should look at is the global market portfolio. Is the global market portfolio. You remember CAPM? CAPM. We talk about the market portfolio. Why we talk about the market portfolio? Because of their assumption. What was the assumption? What was the assumption? Assumption is to diversify the risk. Is to diversify the risk. If you invest in a single stock, you won't be able to diversify. Clear? That's why whenever we talk about the financial theory, okay, we always talk about the portfolio which is diversifiable. Okay. And global portfolio is the most diversified portfolio possible. You cannot find any other portfolio diversified versus the global market portfolio. Clear? Now author have again discussed that diversifiable risk and non-diversifiable risk, so I'm not entering into it, because we know diversifiable means what? Something which you can diversify. Okay. Because one company can fail, bad management can fail, factory fire, they all come up with the risk from a specific company. Okay, so you can diversify it by investing in multiple companies, out of which if one will fail, it's just 1% of your portfolio. Okay, so you can diversify it and you can reduce the cost. But when it comes to the non-diversifiable, market risk, systematic risk, price risk, economic recession, interest rate changes, inflation, wars, pandemics, so these risks cannot be diversified in any manner. Clear? So investors are actually compensated only for the non-diversifiable risk. Clear? But they are not compensated for the diversifiable risk. Means these are the 5 company, you invested in this company, all of your money. Clear? So you won't be compensated for this because you have the option to invest in the market portfolio, but you do not choose that option. So it's your mistake. Clear? So it represents the most diversified portfolio possible and it minimizes your idiosyncratic risk when you invest in the global market portfolio. Clear? And it is also considered as the starting point when you think about the asset allocation decision. Clear? Now you remember though that efficient market frontier from the CAPM like this, and this was the minimum variance portfolio. Clear? And through that I have drawn this line. I call this as a capital market line, CML, capital market line. Basically over here you have the risk-free asset, over here you have all the market portfolio. So you defined out the weight. If you want more risk, you invest over here. If you want less risk, you invest over here. So you are connecting the risk-free asset to the efficient frontier in such a way that it will touch your frontier like the tangency portfolio. Clear? So the point where the CML touches the efficient frontier is known as the tangency portfolio, and the tangency portfolio is nothing but the global market portfolio. This one, this point is global market portfolio. Clear? Global market portfolio. And this point, minimum variance portfolio. Clear? So now what I did, I put up a capital market line and this is my market portfolio, and now I'm calling it as a global market portfolio. So over here these all are my T-bills. Clear? And if I want to make it risky, I'll keep on adding the risky assets. Clear? And suppose I am over here at this point, okay, so what I'll do, I am borrowing at RF and now I'm investing in the global market portfolio. Clear? So this is how theory says that you will end up choosing the global market portfolio. Clear? Now there is one more point, that why I'm using the word baseline portfolio. So baseline means what? Starting point. Starting point. This is the meaning of baseline. Basically the asset class weights of the global market portfolio, they have conditions. Condition what? This needs to be neutral. They need to be neutral. They need to be market consensus view, or you can say market determined, and they should reflect that how the world should invest. Clear? There are 3 points. They should be neutral. Second, market determined, or you can say market consensus view. And third one, they should reflect that how the world is actually investing. Means if global equity is 55% of the world market value, so the weight of my portfolio in the equity is 55%. And if the bond is 35%, then the weight of my investment, my portfolio weight in the bond should be 35%. Clear? Now what we do generally, because I am an investor, clear, so I cannot purely go ahead with the market portfolio. So after starting with the global market portfolio, what I'll do, I'll adjust the weights, because this global market portfolio might not be suitable for me because I have different conditions. You remember goal based approach? Clear? Or might be I am home country bias, means I'll invest only in Indian assets. So I'll invest more of my money in the domestic assets. Clear? Or might be I love small cap stocks, so I'll not invest in the large cap. So I'll invest more of my money in the small caps. Clear? So in that situation, what I need to do? Global market portfolio is just a baseline portfolio. That means starting point, not the final answer. So what I'm going to do? Rebalance, adjust the weight of my portfolio. Clear? Now there is one more issue, that everyone cannot invest in everything. Like there are some assets which are hard to buy. Okay, some are illiquid, and I am an old person, I need regular cash flow. Some assets are expensive, like residential real estates, commercial real estates, private equity. So these are not practical for every individual investors. Clear? So what I'll do, I'll keep on changing this. Clear? I'll change my portfolio weights based on these factors. Clear? So what is the solution is that I will use some proxy means substitute or representative, since we cannot buy everything directly. So what we'll do, we invest in the ETF. Okay, exchange traded funds. So ETF representing your global equity, ETF representing the global bonds, commodities, real estates, etc. Clear? So ETF portfolio can actually represent the global equity, global portfolio, bonds, everything. Now, okay, so now write down one point, mention not over here in the notes, why global market portfolio is so important. Why global market portfolio is so important, write down, because it connects few of the important dots. First is diversification. Second is efficient frontier. Third is market risk. Fourth is your expected return, CAPM. Okay. And the fifth one is asset allocation logic. Clear? That's why global market portfolio is very important, because it connects all these dots directly or indirectly. Now we are entering into the second phase. The phase means how I am going to manage my portfolio. Okay, we have spent a lot of time, means the portfolio have that only, like whether my portfolio should be actively managed or whether it is going to be passively managed. Clear? So we are going to start off with this, but again I am keeping the things in short, which we have discussed a lot in CFA level 2. Okay. Now, the first point which you see over here, the first term, strategic implementation choice. Now see, once your strategic asset allocation is ready, now investors must decide that whether we should stick to SAA or we should deviate from it. This is the first question. Second, how should we invest inside each asset class? Means I identify the asset weights. Clear? Now I have identified that in equity, my weight is 30%. Now, what should be my strategy? How I should invest inside each of the given asset class? Clear? Now, both decision involve that whether I should active management or passive management. Clear? So, basic meaning we know that passive means just follow the benchmark, no attempt to beat the market like index funds, ETFs or holding, but active, you try to beat the benchmark. Okay, you try to beat the benchmark, challenging position based on the views and the forecast. So over here your goal is to earn the alpha, extra return over the benchmark. Clear? So manually driving and overtaking the others, that should be the strategy. Now coming to this point, now what if I take the mix of both active as well as passive? Clear? So this SAA, it is mainly for the long term, it needs to be stable, it is based on the IPS. Okay, like 60% equity, 30% bonds and 10% is on the commodity. Clear? SAA. But when I am talking about TAA, TAA is an active strategy. This is an active strategy. Active strategy means temporarily you are deviating from SAA to get the benefit of the short-term market opportunity. Like SAA equity market is 60%. Now investors believe that stocks are undervalued. So temporarily what you will do, you'll remove this to 5 and make it 65. Clear? Now why we use this tactical asset allocation? Because I want to earn that incremental return. This is the first point. And second, the extra return is known as the alpha. This extra return is known as alpha. I want to have that extra incremental return, and that extra return is known as the alpha. Now this extra returns comes with higher risk, because what if things won't go the way you have planned? Okay, things can go against the tide as well. Clear? So now there is one more point. If there is a high risk, you need to control that high risk. You need to control that high risk in TA. Clear? So TA deviation should not be unlimited. Okay, you should define that how much you can deviate from your SAE. Clear? So over here we allow two things. We allow two things: the allowable risk, or we call it as risk budget. You should be in the given framework, and the rebalancing range means how much you can deviate. Like for the equity, my target is 60%. So what I can deviate is 55% to 65%. So I have the deviation of 5% both the sides. So this actually prevent your excessive risk taking capabilities. Clear? So if we come back to the notes, then I have covered all these points just now. Now you also need to consider the cost and benefit analysis, because if you're deviating, it leads to the cost, buy sell expenses, transaction cost, short-term taxes, and apart from that, risk is also there. Are you clear? So whether after having all these expenses, there is a possibility that you will get the benefit, and that benefit proportionate is what you aim for or not. Because taking small risk and getting high returns, yes, lucrative. Taking risk, say of 10% and expected return of 12%, it's not lucrative at all, because what additional you are earning? 2%. It's better not to do. So cost and benefit analysis. Clear? So one thing I know, that my TAA decision is based on three things. There are three things. First, if I'll find that some assets are cheaper, I find that some assets are cheaper. Second is business cycle. Stage, boom or recession. And the third one is the momentum. Clear? Recent price trend. So based on this, I'll take the decision with respect to the TAA. Clear? One next point is the dynamic asset allocation. Now, it is a multi-period view of asset allocation. Means performance today affects the decision tomorrow. Definitely it happens. Okay. The first point is performance today will impact your decision tomorrow. Now, risk and return needs, it also keeps on changing over time. Means you remember that age criteria started from 18 and 60. Risk return requirement. Over here, risk taking abilities keep on reducing. Clear? Return, if risk is reducing, expected return is also reducing. You remember? Like, I'll give you one example. After a loss, investor may need higher return later because they need to cover up that loss. Clear? Or now there is another possibility, he will become more conservative. He will not invest much. He will take most of his money out. Both of these possibilities are open. Clear? Multi-period view, asset performance in one period affect your future required rate of return as well as the level of risk tolerance. Clear? Now adjustments can be simple or it can be complex. Simple means putting the money from stock to bond or cash to bond, bond to cash, cash to stocks. Clear? Sometimes it becomes complex. You keep on adding multiple assets, removing one of your assets. Clear? So simple TA, just you are adjusting between the stocks, bonds and cash. Global TA, multi assets, multi country, okay, more complex approach. Like right now you have invested in the Indian market, but now you see US markets are more lucrative. So what you'll do, you'll shift your money from India to US. Clear? So till now we have discussed when it comes to the passive and active choice for asset class weights. We have changed the weights of equity, bonds and cash. But now suppose it is written in the IPS that equity weight should be 60%, neither you can increase or nor you can decrease. Bond will remain 30 and commodity will be 10%. You cannot change it. Clear? But then what choices you have? You can change it within equity. That is again a possibility. Clear? So now I have two options. I can remain passive or I can remain active within the asset class. Okay, when I'm saying passive means no investors views are used. Portfolio will just follow the benchmark, that is your equity index, or for the bonds bond index, or for the commodity index. Clear? Now portfolio changes only if index changes, not due to the opinion. But when it comes to the active management, so portfolio changes when expectation changes. So manager will select the securities based on his choice, and his goal is to beat that benchmark on a risk adjusted basis. So return per unit of risk, he want to achieve that to be the highest level. Clear? Now there is one more point to be discussed, that is spectrum between the active and passive. Okay, so now what what does this means when I am saying that look it from the spectrum? Okay, when my portfolio is the most passive portfolio means I just buy and hold the global market index and I'm doing nothing, it's the most passive one. Suppose I say that I have tilted a bit. Okay, so I have tilted a bit means might be I have changed some index. Okay, like for the equity I have changed it to small cap, mid cap or large cap. Clear? Now more I am making it more active. Okay, so what I am doing now, I am trying to change the stocks within that style. Okay, inside the small cap, mid cap or large cap I keep on tilting it. Clear? And the last one, the most active one, no benchmark, full freedom, I can do whatever I wish to. Clear? So the moment we move from this to this and this, my expected return will increase, my tracking error will also increase, and the cost of managing that portfolio will also increase. That's why I have said it a few minutes back. Cost benefit trade off. It's very important because higher trading cost, higher monitoring cost, possible capital gain tax. Clear? So there comes this tracking error, so we need to manage that tracking error as well. Clear? Because when you are indexing, okay, passive is also not free, because index is low cost but still it has some cost. Okay, transaction cost when the index composition changes means you are following an index. Now what if index composition also changes? Sometimes new shares comes out, sometimes one share move out of it. Clear? So transaction cost is basically when index composition changes. Clear? Second is more cost if index is equally weighted instead of market weighted. Then every time the share price is changing, you have to adjust the weights in your portfolio. Clear? And bond index will cost when the bonds will get mature, default or they are cold. Clear? So in that situation, even if you are passive, still there is a cost, though it's low but still. Clear? But when it comes to the active management, it involves huge amount of costing. Clear? Now when it is managed actively, one thing we have to keep in mind, that is tracking error and active return. Tracking error means how much portfolio actually deviates from the benchmark, and expected active return means expected outperformance over the benchmark. Clear? So if my expected return per unit of tracking error is increasing, that means my portfolio is really doing good. Clear? So now how to decide, sir, which one is best, passive or active? See, it's totally depend upon the availability of the suitable index, whether do you have the suitable index or not. Second is the scalability of active management. Okay, means how much value you can derive from it. Investors constraint, ESG, social concerns, liquor, something like that, domestic investment, not foreign investment. How much you believe in the market efficiency, because if you believe that market are efficient, then trust me, passive is best. Otherwise, go with the active management, cost benefit trade-off, and the last one is the taxation status. Okay, because if the investors is tax exempt, then it's fine, but if it is taxable, then trading will cost you short term gain. Short term gains are highly taxable versus the long term gain. Clear? Now we have is this risk budgeting. Risk budgeting means deciding how much risk we can take. Okay, and second, from where we need to take. So the focus is on the risk, not on the return. When I am talking about this, my focus is only risk but not the return. So risk can be measured as volatility and tail risk. Volatility, that is standard deviation. Tail risk means extreme losses. Okay, tail is value at risk, volatility standard deviation. Now, risk budget means how they are defined. Sometimes it is in terms of the absolute or relative. Absolute means you can take the risk of $300 or you can take the risk of 3% of the total portfolio value. So it can be defined into absolute or relative. Like portfolio volatility should not exceed 10%. Clear? Now, risk budget will tell you two things. One, how risk is distributed among assets. Clear? How risk is distributed among all the asset class, equity, bonds, commodity, like this, without considering the expected return. Clear? Sir, risk budgeting also needs to be taken care when you are deciding about the passive or active strategy. Okay, like if it is a active risk budgeting, so it decides that how much extra risk an investor is willing to take relative to the benchmark. Okay, because my goal is to outperform the benchmark, but still I have to stay in limits. It is for active management. Clear? Now there are also two options. I can measure the risk within the asset class, or I can measure the risk between the asset class as well. Suppose I'll say that 60, 30 and 10. For this, risk variability highest is allowed at 8%, 3% and 2%. So I should not deviate from these numbers, risk for the given assets. Clear? Similarly, I can tell you within the assets, within the equity, long term, mid cap and small cap. For this, risk variability should not exceed 12%, say 4%, say 9%. So I have to maintain those risk budgets. Clear? Now we are in the last section of our discussion, that is your rebalancing. Okay, we have discussed a lot about this rebalancing in our previous level 2, level 1, but now we are going to look from the asset allocation perspective. So now rebalancing means what? Rebalance, okay, means you have disturbed the portfolio. This was your original portfolio, you have disturbed it, and this is your new portfolio. Now bringing the portfolio back to the original asset mix, target weights, when it move away due to the market movements. Clear? Like strategic allocation was 60% to the equity and 40% to the bonds. Now after a stock market rise, okay, what happened? Your portfolio value will increase for the equity, and now it became 70-30. 70-30. Clear? So now you have to rebalance it. So how it increased? You have invested say $100 over here. Clear? Now total value of the portfolio, $60 to the equity and $40 to the bonds. Now the value of the equity is increasing. Now what happened? So this value suppose turned down to say $90. Okay, the value of the equity increased. Now what is the value of my current portfolio? $130, 90 in the equity and 40 in the bonds. So what is my ratio right now? Ratio is 90 divided by 130. It is 69.23, and this one is 30.76. Now this weight is different from your target weight. So now what will be your next step? Your next step is to buy the bonds and sell your equity. You have to buy your bonds and sell your equity. Clear? So you will sell $12 of equity and you will buy the $12 of the bond. So now this is your new rebalanced portfolio, 78 into the equity and 52 in the bonds. So now again your ratio is 60 and 40. Clear? Now why it become necessary? See, because your portfolio asset price is changing and we call this as a portfolio drift. You moved away. Drift means moving away from your target weights. So even if the investor does nothing wrong, asset price naturally moves and they will disturb your balance. Clear? Because you have to follow the IPS. So strategic asset allocation and the IPS, they both are linked. Clear? So strategic asset allocation is based on three things: long-term goals, risk tolerance, and third one is your IPS. Clear? So this allocation is usually given as a range, not a single number. Okay, like equity target is 30 to 40%. Why I am not giving a single number, say 35? Because then every day this number will change. So it's very hard to manage. Clear? So if equity will go below 30, I'll take the decision of rebalancing, and if it will go above 40, I'll do the rebalancing. Because if I'll keep just 35 and if it will become 36 tomorrow, I have to rebalance. If it will become 34 again yesterday, then I have to rebalance. So it become very difficult to do all these things. Clear? So what is rebalancing? This is done. Why we need to do the rebalancing? Because we have to maintain the disciplines, we have to maintain the risk exposure, cost of rebalancing, everything we need to keep in mind. But before going towards that, what we need to understand is the primary benefit of rebalancing. See, we have to maintain the desired exposure to the systematic risk. Okay, so if we will not rebalance it, then suppose what will happen to my portfolio, the risk part of the portfolio, equity and bonds. Equities are more risky. Now I am more exposed to the risk. Clear? And now risky asset will dominate the portfolio. So what will happen? Overall, the portfolio risk will increase without investor is actually realizing it. Clear? Because see, equity generally will give you higher return for the 5 years. And suppose you will not rebalance, then equity will become 80% of the portfolio. Portfolio will become very risky, and investors will never agree to this level of risk in the IPS. So only way to rebalance your portfolio from the risk perspective, bring it back to the original risk, bring it back to the original characteristics. Clear? So maintain the risk exposure is the primary goal. Second goal is to maintain the discipline. Discipline means what? You have to follow the rules. Okay, not acting emotionally. Many investors think that equity is doing well, let it ride, but this is emotional decision making. Okay, we should not do that. So it prevents let it ride behavior. When equities rise, it actually lock in the gain by selling the overvalued assets. Okay, when you rebalance, you sell the assets at a higher price, take the bonds, your portfolio is now safe, and you have also made the good returns, and never act emotionally. Clear? Now there is a problem with this term, let it ride, because gains may be temporary. Because right now, suppose the stocks are over here, it can again come back to this level. Okay, so better you will book your gains. Okay, sometimes assets are overvalued, better you sell them off because the price may fall later. Clear? So not rebalancing means failure to lock in the gain. You won't be able to get those gains, and you will miss the chance to sell the expensive asset. Clear? So this is a hidden cost of not rebalancing your portfolio. Clear? Now third is the cost of not rebalancing. Now rebalancing is not free. Okay, rebalancing comes with a cost because you have to buy and sell. So transaction cost, brokerage, bid ask spread, and tax liability. Okay, if you are selling appreciated assets, you will have the gain, capital gain, and now that capital gain need to be taxed. Clear? So these 3 points we have done it. Now liquidity effect on the cost. Liquidity is very important when you look at both the bid and ask spread. Okay, so like if you sell when everyone is selling, you require liquidity because everyone is selling, no one is ready to buy. So bid ask spread is high, cost is also high. So and if you sell when others are buying, you provide the liquidity, costs are lower. So always remember when to sell when everyone is not selling it, then your bid ask spread is low. Clear? And hence your cost is also going to be lower. Now why you should not rebalance constantly? Okay, like if we balance to the exact target every day, so trading will become continuous, transaction cost will explode, impossible to time trade perfectly because today share market is like this. So it's very hard. That's why I give a range. If it will cross, I'll rebalance. If it will cross, I will rebalance. Clear? So rather than focusing on the exact targets, focus on the range. Clear? Now rebalancing have two different approaches. Okay, one is your calendar based, another one is your percentage based. Calendar based means what? Fix at a given time interval, monthly, quarterly, or yearly. It's very simple, very disciplined, without constant monitoring, and easy to implement. Clear? But drawbacks are also there. Portfolio may drift a lot between the dates, means 1st of January 2026, 1st of February 2026 share market took a 30% increase. That means now your portfolio is very much disturbed. The cost of equity is also very high. Clear? So rebalancing depends upon time but not on the value. Are you clear? Now coming to the next one, that is your percentage. It can happen tomorrow, day after tomorrow, or sometimes it can take months that your portfolio will not cross the range. Clear? So rebalancing is only when asset weights move outside the range. Clear? Now over here, your control with respect to the risk is much better. Okay, asset weights don't drift too far because in the time there is a possibility that you have given 1 month. Okay, that you will check it after 1 month, your weights is 50%, and you come back after 1 month and you will identify the weights are say 50-50 and now the weights are 70-30. Okay, it can create huge amount of risk, but in percentage range you can control the risk better. Clear? So asset weights will not drift too far, but there is a drawback. It requires constant monitoring, may leads to the frequent trades, higher monitoring and trading cost. All these things are the part of your percentage range. Clear? Now over here you will see this key questions when applying the corridor. What is this corridor? Same, that percentage range corridor. Okay, so there are some questions which manager must answer, like who is responsible for rebalancing. Okay, how often portfolio will be monitored, how wide the corridor be. Okay, if it's too small, huge frequent rebalancing, and if it's way too wide, then it will be difficult to keep that level intact. Okay, and should the rebalancing will be fully or partially to just to correct the drift, means this is important. This is your range and this is your mid level, say 60, this is 55 and this is 65. Suppose you become 66. Now will you make it 65 or will you make it 60? Okay, fully or partially, just to correct the drift. Clear? So we need to consider this strategically when I'm deciding for the corridor width. Clear? Now over here I have 6 very important points to be discussed. One is your transaction cost. That is clear because there I need to consider two things, cost and illiquidity. Okay, risk tolerance, whether we are more risk averse or whether we are less risk averse. See, transaction cost means if it is too small, high cost. If it is too wide, then low cost, because then we don't need to do the transaction very frequently. Okay, if suppose if it's a real estate, then I have to keep the width wide because they are illiquid. You cannot sell it today, tomorrow, day after tomorrow. Clear? If your risk tolerance is more averse, then you need to keep it very tight. Okay, that you cannot go outside the corridor. But if you're less risk averse, you can take the risk, make it wider. Clear? Correlation between the assets, if high, then less frequent rebalancing needed, because asset and bond, they both are moving up together. You're automatically balanced. But if the correlation is less, then you have to rebalance it. Clear? Momentum versus the mean reversion. This means what? Momentum means trend continues. Then use the wider corridor. Mean reversion. Okay, we know that our value will revert back to mean again. Then use the tighter corridors. Clear? Over here, liquidity covers up again. Okay, illiquid asset, I need to have the wider corridor. Use of the derivative. So instead of selling the asset, I can use the futures, swaps and options so that I can manage my risk. The focus was to reduce the transaction cost, reduce the taxation part and faster execution, but it requires additional risk management. Derivatives add complexity to it. Clear? Taxation is also the criteria. If taxable portfolio, I need to keep it wider corridor. I don't want to do buy and sell, get the gain and then pay taxes. Okay. So if tax exempt portfolio, I can keep it tight. If it move out, I'm ready to sell. Clear? Now, there sometimes you'll find out that corridors are asymmetric. Means your target is 50%, target is 50%. And corridor is, suppose over here is 50. So what you want the corridor to be? 45 and 55, symmetrical. But sometimes you will find out the corridor is 48, 50 and 55. Asymmetry. Okay. So it basically you allow more upside, but as soon as it moves down, you want to harvest the losses. So we call this as a tax loss harvesting. I don't want my portfolio to go down. I want to protect myself. When it is going up, it's fine. Going up, fine. But over here, I'll sell it. Okay. I will sell it because I want to avoid the taxation. Because suppose if it moved from 50 to 52, then if I'll sell, I have to pay tax. I have to pay the tax. That's why I keep it asymmetry over here. Are you clear? Just one or two points before we close this session. Now, the role of the asset class volatility. If the volatility is high, then weight changes are very frequent because they are crossing that bar very frequently. Clear? So high volatility, we need tighter corridor because we want to control the risk. Okay, this is the one way of thinking. Second is high volatility leads to frequent trading, leads to the high cost. Suppose I know that this stock 50, price is 50 at present. I'll keep the corridor over here, say 42 and 60. Okay, because I know that it is trading between this range. Though it is highly volatile, you can see it is moving very frequently. Sometime 58, sometime 44, sometimes 50, and sometime like this. It's moving like this. Suppose this is the line of 50. So 58, 44, 54, 42, like this. So highly volatile. But I keep the limit knowing that this much risk I can manage. Otherwise, if I'll keep the strict limit, very frequently I have to rebalance, leads to the higher cost. Clear? So there is no basically final decision on how much the corridor width needs to be, but I have to choose based on the risk control, transaction cost, correlation, volatility level, risk averseness. All these things are the factors which are considered throughout. Clear? So with this, I can end this lecture here. I have completed each and every point of this topic. Thank you.